Have you ever sat at your screen and you're just forcing trades only to watch the market just chop sideways and eat up your profits? If you're a trader, we've all been there. But the truth is, not every day is a trading day. And if you don't learn when to sit out, the market will teach you the hard way. So in this video, I'm gonna break down the key signs that tell you when to trade and when to step back. The market ultimately doesn't move the same way every day, right? Conditions are always changing. Some days are trending, some are choppy, and some are just completely dead, it feels like. So if you try to force trades on low quality setups, you're ultimately just going to be donating money to the market. 3 reasons to avoid trading on certain days include: one being if there's low volume. Low volume ultimately creates and breeds low volatility. And if the market isn't moving, your trades just won't either. Low volume indicates, a lack of follow through. It makes it easy to get chopped up. And ultimately, the thing is that you really want to pay attention to here is that just understand that without other market participants involved, there won't be any big moves taking place. So there's really nothing for you to miss out on. Number 2 is going to be unclear market structure. If the structure isn't obvious and there's just not a ton of things that you can point out, really, your edge is ultimately not going to be that clear either. If your edge isn't present, you have no trade. If price action is just randomized, it probably is. So just let things chill until you have a clear view and you're able to really come up with a good solid trade idea. Another thing is going to be when there's big news events ahead. Typically, there are going to be things like CPI, FOMC, major earnings reports. Those can bring extreme volatility, and a lot of times heading into these events, the market will kind of just anxiously wait in anticipation of a big move. And this can make it potentially risky to enter before the dust kind of settles and those reports get released. Something that you really want to remember is that pro traders wait for the right conditions. Amateurs force trades. They create trades where there are none. And that's not something that you want to do. A couple key warning signs that can tell you to stay out, especially as you're heading into the open on any given day, is if there's just a flat open with no direction. If the first 30 minutes show choppy price action with no clear trend, then just sit tight. Another thing is going to be inside days. So if we're trading within the previous day's range without any decent movement, then definitely be cautious. This is a telltale sign of a choppy market. Another thing is going to be when we're overextended. If we've already made a large move within the past few sessions, typically a pullback or a consolidation phase is more likely than a continuation. Before every session, definitely ask yourself, do I see a clear opportunity or am I just looking for money? If you're just looking to make money, you're gonna be forcing trades and you're gonna be just seeing things that aren't really there. Sitting on your hands isn't just about avoiding losses, it's also about preserving your mental capital. Trading is about patience and discipline. What you gain by not trading bad setups is almost just as important as steering clear of what you might lose. Some of the things that you can benefit from when you stay out of bad opportunities is, you're gonna have better focus. You save energy for high quality setups. You're ultimately gonna be left with more capital because you're avoiding bad trades, and that means, more money for the right opportunities. You're also just gonna be less stressed. There's no need to, fight the market when it's not playing fair. You're not gonna be pulling your hair out. It's just gonna create a much more calm environment for you and within yourself. Ultimately, some of the best trades are gonna be the ones that you don't take. They're gonna be the setups that you're thankful that you didn't force, that you're grateful that you didn't create a loss where there didn't need to be one. The key takeaway from all of this is to choose your battles. Not every day is a trading day, and if you have an actual strategy and a real edge in the market, that is okay. You cannot force your will on the market. You have to allow the conditions to present themselves that make it optimal for you to trade and to actually deploy risk and implement your strategy. And that only occurs when it presents itself, not when you try to fit the conditions into, you know, what you want. The best traders ultimately know when to strike and when to wait. If this video was helpful, definitely drop a like and comment down below what your rules are for knowing when not to trade. And just make sure to subscribe for more insights, and I will catch y'all on the next video.